from where we ended yesterday, then I will what I will do is go into fundamental from this point of view. So I'll just finish up on the part we left yesterday on how to mark those key regions or key areas I said yesterday, and how to take your trade when the market reaches on that key level. So as I said yesterday, for you to trade, you have to know the trend. After knowing the trend, you mark the key levels where the market is likely to experience a shift after a certain move to your direction over a certain period of time. So every time what you are supposed to be doing is to mark a key level, then wait for the market to retrace to that area, then you take your trade going with your trend as usual. So what you be doing, I'll be guiding you on how to mark those key levels. That yesterday, these guys asked about what candle are you considering while marking those key levels and other things. So today, I'm going to show you what candles do we mark while marking these key levels and what do we consider. So, as I said yesterday, the first thing first is to know the trend. After you know the trend, what you're going to do is finding a key level that will be aligning with the trend of that current market you're trading. For example, when you look at this GBP/USD, as GBP/USD, what we see here right now, it's a downtrend. So, what am I going to do here is to look for a key level that, after the market reaches that point, it will align and continue with my downtrend. For example, what you can see here is that GBP made a break of structure here. I see this is it went down, it went it went up, it went down, it made the first break of structure here. As I said yesterday, if you see the market breaking down and once it's created a high, this high does not exceed the previous high, it means this is a downtrend. If you remember yesterday, like the market goes up, goes down, goes up, goes down. Once it goes down, it breaks the previous low. And once it comes up to retest, this high created does not break the previous high and it creates a new low. You see this new low here. And this new low created has made this break of structure here and create a new low. Once the market retests back with another high, this high does not break the previous high. So this is show the market is downtrending. So after I know this is my downtrend, what am I going to do? Is looking for a key level that when the market reaches, it will continue with my trend to the downside. I hope you're catching. Someone said in the comment there's no sound. Is it true? Or is it on its own side? Come on.
I can hear you. Usually, can you hear us? Okay, sure.
I can hear you.
Okay,
sure,
so it means okay. So what we're going to do here is, as we already know the market is downtrending, we're going to look for a key level to which when the market retraces back, it will continue with our trend to the downside. So as you see here, the first move, it made a break of structure, creates this low, and this low comes back to create this high. This high, it ended over this point here because this is the point of interest when the market retraced before breaking the structure. So this is an area where the market will come back and we will experience a move to the down. But as we can see here, this was a gap over the weekend. So what the market did, always after every gap, this is something you should consider. After a market causes a gap, that gap will be filled. That's the must. Either it will be filled within the same day, or it might go down, then comes to fill it later on. But what you should keep in mind that the market will fill the gap by any means. So as we already know here, this is what the structure we are having right now. Well, over this structure, it's on an overall downtrend. So what you're going to do, it is to look of what we have currently. What we have currently is this break of structure here. Once the market caused this gap, it break this low here. So what we are waiting for is the market to retrace back to the area where the movement began when this low was broken. So how do you mark your key level? A key level, or I call them supply and demand zone. A supply and demand zone, let me start with a supply zone which is on a downtrend. while the market is trending, you're looking for supply zones, to which those are the areas where the market, when they reach, they will experience a rapid sell from that area, or there's a selling power over that region. So what you're going to do, you're going to mark those regions so that when the market comes back there, you're going to catch your downtrend movement or your sell trades from that point. So how do you mark these regions, and how do you know which region is a supply or which region is a demand zone? For as I said, in a downtrend, we are looking for supply zone, and in an uptrend, we are looking for demand zone. So, as we know, this market is a downtrend. What we are looking for is a supply zone. A supply zone, any area where the market reached, then it went down rapidly, which also made a break of structure. When the market dropped rapidly and also made a break of a previous low and creating a new low, that it means where the market began that move, it is a supply zone. Let me show you something here. What you will consider. Let me this here. Let's assume this here there's a chart here because there was a gap here. So let's assume now there's a movement there. Like I have connected this chart. So it means the market has go down, then it's a made a structure, creating a new low, then it's come back. So what you're going to do here is to mark the last candle before this sell happened. To which on this scenario here, what was the last candle before this sell? It is this one. You can see this one. This is the last candle before this rapid sell. So the last candle which was on the buying move before the rapid sell, this will be our key level. We're marking it like that. You'll take a tool called rectangle on a trading view. This side here, this is the tool. Then you use to mark this whole candle from the wick to the wick, from the top to the bottom. Once the market comes back inside here or touches this region, which is the key level, we expect the market to continue going down. Now, on what conditions? On what time frame are we considering this region? We are using 4-hour time frame to mark our key level. So once we know this is the candle, the last candle on the up movement before this rapid sell, which made a break of structure here, it means the last candle on the 4-hour time frame. This whole candle will be our key level. So you're going to mark this whole candle and cover it with this rectangle tool. So when the market comes back in here or touches this area, you are going to look for sell opportunities. Okay, now that's the first step to consider. Now, let me take another example on an uptrend and looking for a demand zone. Catch me clearly on this. Now, let me look for a good pair which will be easy for you guys to understand. That concept was on a supply zone. Now, I'm going on a demand zone, on how to mark a demand zone. That was a supply zone. Let me look on a pair which is very easy to understand. If this USD is okay. Let me see. Okay. I think this will be easy for you guys to understand. Okay. As you can see here, for the supply zone, we are looking for the last candle on the buy move before the rapid sell. But on the demand zone, as we know, maybe the pair is on an uptrend like this. This is an uptrend. This pair is uptrending. You can see here from this point to this point, the market is going up. So it's uptrending. So what we are looking for on an uptrend is opportunities to take buys or demand zone. So this is our zone. Why this is our zone? Because on a supply zone, I said we mark the last candle before the rapid sell. But on a demand zone, we mark the last candle on the sell movement before the rapid buy. And this rapid buy must also make a break of structure. You must listen to me this session very carefully. You must also see a break of structure. Like the market must go down, then when it goes up, break the previous high and create a new high. And when the market comes back to the area where the market began this move, which made a break of structure, this will be our demand zone. And as we drew our supply zone, the same concept you're going to use to draw our demand zone. What we're going to do is to mark the last candle before this buying movement and recover it all. So this will be our demand zone. Once the market comes back to this region, even touches it or enters inside here, we are going to look for opportunities to take the buys. Okay. But what we must not that for an area to be a correct demand or a supply zone, we must see a break of structure. And also, this movement must be strong. Like we must see a good buy from that area. As we see a good strong buy, it means this area has a potentiality of buyers to wait or putting the pending orders here, so that when the market comes back to this region, we are expecting to see another buy going back to the up. So as we can see, when the market comes back here, we have seen it as made the movements to go up. So this obviously it's our demand zone. And what we saw here on I'm not sure it was video here. Yeah, what we see here, it's a supply zone. So once the market enters your zone, either a demand zone or a supply zone, that does not give us any authority to take any buy or any trade. Yes, because the market has entered your zone. No, you have to consider some things before taking a buy or a sell on your zone. We call it trading in the zone. Even if the market has got into your zone, does not uh, does not guarantee you to take a trade. Why? You must see some characteristics or some changes on the market direction before taking your buys or your sells. So yes, because your market has entered your supply zone on 4-hour time frame, does not mean that you're going to MT5 and place a sell. No. We're going to wait for is to see the market has changed character inside here and give you a confirmation that, okay, now I'm going to sell. Just because your market has entered the zone does not give you the confidentiality for you to take a sell. Because sometimes these zones might be broken. The possibility of the price to keep on pushing up, even if the zone is correct. So what you're going to do, once the price has entered your zone, what you're going to do is wait for the price to do a certain movement or a certain change of character in a smaller time frame. So from 4-hour, what you're going to do is move to a 30 minutes time frame, like here. So on the 30 minutes time frame, what you're going to look for is something like this. Let me draw it to you here. So the market has entered your zone. Wait for the market to get out of your zone and made something like this. This is the first reaction. So let's assume this is your zone. Wait for the market to enter in the zone like this. Then it comes out like this and enters again and comes out and made a break of structure. Make sure you see something like this. Let me let me do this to keep it simple, because this is where people are getting complicated. Oh, sorry guys. Sorry. This is your zone, and what the market did. So forget about this thing I created. So what we are going to do here, the market has entered your zone. Wait for the market to react on the zone. Once the market reacts and rejects and makes a break of structure here on a smaller time frame, that is 30 minutes, 15 minutes to 5 minutes, depends on the pair you're trading. So once the market rejects and breaks another low and creating a new low, that's when it gives you a confirmation that the market has changed character. So after this break of structure, wait for the market to come back again on the zone. And this is where you're going to take your sell trade at this point here, where the market began the move that made this break of structure. And this is after the market has entered into your zone in a higher time frame. Now you're going to shift to a smaller time frame, like 30 minutes and 15 minutes, so that you can see this change of character. Once you don't see this change of character, it means the market will continue to buy. But once the market enters the zone, then rejects, breaks the previous low, and the market comes back to the area where the market began this move, which breaks the structure, then this is where you're going to take your sales. Once you take your sales here, then you're going to consider like this is a confirmed entry. And always your stop loss are going to be above your zone. So if that's where you took your entries, make sure your stop loss is somewhere outside the zone. Okay. Now that's on a scenario of demand or supply zone. The same case on a demand zone. This is your demand zone. What I'm going to do is wait for the price to come back to that area. Okay. Maybe the price was moving, then it came in. Wait for the price to reject and break a break of structure here. Then it comes back again where the movement which way the break structure began. Then this is where you're going to take your buy here at this point here. So what all you're going to regard is the market to enter your zone, reject in a smaller time frame, 30 minutes to 15 minutes. Then once the market comes back again to the area of the beginning of this move, which made this break of structure here, this is when you're going to take your buys here. So I don't expect anyone to take entries just the moment the market enters the zone. No, you must first see this rejection. Like the market enters the zone, rejects, makes a break of structure, then comes back again. Is when now you're going to take your buys. And on the sell scenario, wait for the market to enter the zone, rejects, breaks structure, comes back again. This is where you're going to take your sales trade and continue with the direction. And make sure, consider this on a uptrend, look for these demand zones. On a downtrend, look for supply zones. Always, this will be easy for you to catch these moves. And as I told you yesterday, on a downtrend, we are focusing on catching those rapid moves of selling, and in an uptrend, we are focusing on catch these rapid sales. I mean, these rapid buys, these rapid moves of buying. So always, the market moves in rapid correction, rapid correction. So in an uptrend, we're expecting to see a rapid correction, rapid correction. So always after correction, you take your entries to catch these rapid moves. Also in a downtrend, we are expecting to see rapid sell, correction buy, rapid sell, correction buy. So after every correction, you take your rapid sell on the zones that the price has made a rejection. Don't take your trades when the price has not made any rejection or change of character in a zone. That will be an invalid trade. And sometimes people are forced to take trades when the market has just entered our key level without considering anything, where the market has rejected that zone, or there's a change of character that's happened, or there's break of structure. People don't consider that. They just look for a zone. The market enters the zone, they place their trades, and the market continues to 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 break their zones, and they start blaming that this strategy is not working. But while you have not considered every rule that it is involved in that particular strategy. So, as in a live example, what you're going to wait for here is that now this price has entered our zone. Let's wait and see the change of character. Like the price enters our zone, rejects, breaks structure, then comes back where the market began to break this structure. So as the same thing we are waiting for is to wait this thing to this GBOC to enter inside here and comes back out, makes a break of structure, then comes back in, then we sell. But if something that like that does not happen, we're not going to take any trade at that moment. That's the simplest way of trading on these key levels. Or you can just be an aggressive trader. Like if you have enough capital, you can wait for the price to enter the zone, take your sell without considering anything, and put your stop loss above the zone. To which this is for people who have good capitals, because if you have maybe $20 or $30, you cannot manage this stop loss, because for example when you take your sales at that point, it means your stop loss has to be like 40 pips or 39 pips above. Now for me, I like to use big lots, so I cannot afford this big stop loss. So what I'm going to wait is to see a full change of character, so that my entries can have small stop losses and have a good possibilities of using good lots on that area. So that's the picture on how to trade on those key levels, as I explained yesterday. Now, moving to the guys, I'm sorry, I'm going fast because my laptop has some problems. I told us I gave you yesterday, and I didn't manage to get out of with the office laptop today because I had session until night. So I'm going to just have an 1 hour session today, not 2 hours like we agreed. So as that is the way of trading in the zone or trading on those key levels. As I said, you mark uh, the the whole 4 hour candle or on the last candle of the previous move. For example, if this was a buy and you're looking for an area to sell, it means it will be this candle here where this buy movement ended. This will be your key level. The same things apply to the supply to the demand zone. It means it is the last candle after that sell, after the sell where the movement that of buying began. This will be your zone. So if you manage to mark this area as well, now you'll just be one step ahead on mastering these uh, marking key levels. So what you guys are going to do is uh, make sure you go and tomorrow I think in the group you can practice on how to catch this how to draw these zones so that I can know if you guys are gotten my point. Now we are going to the fundamental part which was supposed to be the today's session. The fundamental part of this is that we have to know. I said yesterday we have technical analysis, then we have fundamental analysis. And I said, what is fundamental analysis? Is the way of analyzing the market by considering news or economic events that are supposed to affect a certain currency or a certain stock or a certain instrument you're trading. And this news we have of two types. Okay, we have two types of news. One is macro economics or macro news. Those who have studied economics, they can understand me better. And we have micro economics. Okay. These are the two types of news or two types of fundamentals that you must consider while making a fundamental analysis on a certain instrument. When I say macroeconomics, I mean these are all those fundamentals that affect a certain pair or affect a certain instrument to an high extent. This might be those huge news like NFP, CPI, or maybe Trump is speaking, or maybe there's a war between Russia and Ukraine, Israel and Palestine. All those are microeconomics because they are big events that cause direct impact to a certain instrument like gold, like USD, like anything else. Okay, so these are called macro fundamentals or macroeconomics, and we also have microeconomics or those small news, like uh, just small news of maybe a certain company, like you're trading a stock. So there are those news which are only impacting Apple or are only impacting uh, uh, Facebook. So those are those little news that also can affect the market, but not to a high extent. Or for this microeconomics to bring an impact, there must be many that brings a certain pattern on the market. So for you to see this news, it's very easy. We have a special calendar on our websites or as a trader that you must focus on them. We have this called Forex Factory. Let me load this in to to see. So as you can see here, I have filtered my calendar to only show those news which has high impact on the market. But for because for me, I only consider those macro fundamentals. I don't care about those small news. So what I'm going to show you, I'm going to show you all the news. Does not matter it's micro or macro. I'm just going to show them all. Okay, now you can see here. Now on this calendar of mine, you can see all the news. So where we get we have special calendar as a trader. You must know it's called Forex Factory. It's not Forex Factory. We have another one called this one. It's an investing economic calendar. So you might use this investing.com or you can use Forex Factory. But for me, I am more used to Forex Factory than investing.com. But they are all aiming at portraying the same thing. So coming back to this Forex Factory, all those news you see here, these are micro and macro news. For example, Bank of Japan summary opinions. This is a micro news because it only affects the inside of the Bank of Japan. Nothing major that might affect uh, the country or another currency at large. So all the news you see, they have highlighted in yellow and orange. If you see this first of all, let's start with this. When you see this gray indication, it means this news it's a holiday. All holidays are marked with this gray sign. Once you see there's a news marked with yellow sign, it means it's a news, but it's micro news. It has low impact on a certain pair or a certain currency, or it does not have any impact at all, but just there that we have this uh, calendar of this news to appear. So all those news marked in yellow, they they might have no impact or very small impact on the market. Once you see orange sign or marked with orange, it means uh, this news might have a medium impact on the market, not much big impact, but also not small impact, a medium impact on the market. So this is something you must also keep an eye on. But once you see the news is marked in a red indication or a red sign, it means this news is a macro news that it has high impact on the currency or on the market. You'll see this impact of this news on the market. As for today, this news we had this uh, job openings. This is as a rate in America where they calculate how many jobs have we opened this February month with. So this news has high impact on the market. So what you must do is consider this news the time it's released. Maybe you have your trade running, you can consider closing it or break even or use a stop loss during this high impact news in the market. As a lot of people who have been in trading, they might have come across these few terminologies. Like this week we have this what they called NFP. NFP. I don't know if you guys have come across with something like that. NFP is a macroeconomic, which we have its definition here. This is a change in number of employed people during the previous month, excluding farming industry. It's called NFP, and the length of NFP is non-farm payrolls. What's the definition of non-farm payrolls? It's the rate of or the number of people who are employed in the country or in America, NFP especially for America. So the number of people who are employed in USA, but out of agriculture industry. Okay, so all people who have employed or are have they have works or jobs, but out of agriculture field. Now, if this NFP gives us the number, they give us the number of how many people are employed out of agriculture, like for the previous month. For example, on Friday we have NFP of the previous month. Every new month we experience an NFP of the previous month. For example, on January, the NFP of January is to give us the rate of employment of December. So this of February, they give us the employment condition of January. Okay, now you get my point. It's a number of people employed out of agriculture during the previous month. So once you see the NFP of February, it means it's a rate of employment of the January. So what we're going to consider here, like this Friday, is to see if you see the number of employment has increased. Okay, any sign of increase in employment rate in a country, it means that country economy is doing well. I don't know if in your education bus you have this, but we were, while we are studying on my secondary level, we had these indicators of a good growing economy. So once you see the number of people who are employed are increasing, it means that economy is doing wonderful. So when you see the NFP is released and the data comes out that employment has increased, it means that specific currency will increase in value on that day. For example, on Friday, once the NFP data comes out positive, like the employment uh, number has increased, it means we are going to experience a push to the up, or a buy, or a gaining of strength in the uh, dollar currency. Okay, so uh, on the controversial, once you see the market is sorry, not the market. If you see uh, the specific news has come out negative, like the employment has reduced in number, like people who are employed out of agriculture field have reduced in number, it means the economy of the country is not doing so well. So it means we are going to see a sell in USD during that NFP day. Okay. Now, if you see people making noise, NFP, NFP, NFP. Now you know what NFP means. It means the number, just the number of employment of people who are employed out of agriculture field. If the number increases, then the dollar is going to gain strength. If the number decreases, it means dollar is going to lose value. So, for example, you are trading USD JPY. I don't know if you guys know this concept of base currency and quote currency. If you are trading this pair, USD JPY, as you can see it here. So, for example, NFP is coming out positive, like the number of employment has increased. What are we going to do on USD JPY? You guys, I think, try to answer me that. If the number of employment has increased during NFP, maybe, what uh, what are we going to do on USD JPY? For example, now it's Friday, like the coming Friday, and NFP has come out positive. What are you going to do on USD JPY? I need to see your
It's
ideas
buy.
here. What?
The buy.
It's a buy.
You buy.
Why is it a buy? It's a
You
okay.
buy.
It's a buy because USD is the best currency in this pair. Okay, so we are going to regard on US dollar. If this pair could be starting with maybe another pair, then USD, or maybe it could start with Euro, then USD. It means it's going to be a sell because we're going to use the rule of base currency and quote currency. If the USD is the base currency and it's just strong, it means it's a buy. If USD is the quote currency and USD gains strength, it means it's a sell. So it's Friday, NFP has come out positive, so it means in USD GPY you're going to buy. And it's Friday, the same scenario, USD has come out positive, or the news has come out positive. Okay, the news has come out positive, and it's Friday, and it's in a pair GBUSD. What are you going to do? You're going to sell because USD is a quote currency. It means GBP must lose value for USD to increase value. Once USD increases value, automatically this will lose value. So the news has come out positive. It means dollar has gained value. So it means we have to sell here. That GBP must go down because USD has gone up. That's the picture you're having here. So anytime you are trading a certain pair, and you have NFP, and maybe that pair has USD, you must know how is this pair going to be affected by this fundamental. Like if USD is a base currency, it means it's going to be a buy. If USD is a quote currency, it means it's going to be a sell. And vice versa. If USD has come out negative, or the NFP has come out negative, that USD is going to lose value. It means here in USD GPY, what are you going to do? You're going to sell because USD has just lost its value. So you're going to sell. But coming to this pair, like GBUSD, Euro USD, or any other pair with USD as a quote currency, it means you're going to buy because this GBP will gain value as USD has lost its value. That's how you're going to figure out on what to do on these pairs after you have a news release. So you must be very careful on how a certain pair is going to be affected by that particular news. What most of the people say, maybe during news, don't trade, stay out of the market, wait for the market to finish that volatility, then continue trading on the normal market. But what I say is based on your own decisions. You have to know how you are managing. How you have to know how you are managing your risks, because trading news, I can tell you the truth, is very risky. because at that moment, the market is experiencing high volatility. So what you're going to do is to consider this news trading as a risk. So what you're going to do, make sure the money you are having on your account during news, uh, it's protected with a good stop loss or some even with some money and learn of volatility. Because you can see during NFP, the market might rapidly move area in a period of 1 minute, from here to here, in a period of 1 minute. Yeah. Um, the moment the news is released, you can see a shoot of a candle this point. So once maybe you had your sales here, consider using a stop loss during news or even existing the trades during news. But personally, I trade during news. So like currently I'm patiently waiting for NFP on Friday so that I can make money. So some people we trade news, it depends on your risk appetite. And some people uh you might have you might be scared of this high risk market or high volatility markets. So it's advised for you to stay away from the markets and wait for the volatility to calm down. Then you can come and trade. No.